Okay, Bismillahirrahmanirrahim. Let's start with the today's session. Today we are going to start with the new standard, with a new chapter, and the chapter or the standard that we are starting uh, is IAS 21, that is foreign exchange, foreign currency. Okay, first we will discuss as usual the importance, exam importance. We'll discuss the exam weightage, that how the standard could be tested, and then we'll going to look after the scope of this standard. So what is IAS 21? First try to understand this, that what will be the exam weightage and the importance for this particular accounting standard IAS 21. So IAS 21, basically IAS 21, it's important standard, and the exam weightage is around 2 to 4 marks. Although it seems like that this is quite lower, that only 2 marks or the 4 marks could be tested, which means one or two MCQs could be tested from that particular accounting standard. But remember, in F7 financial reporting paper, every 2 marks or every MCQ will be considered. Every MCQ will have an importance. Why? Because, for example, God forbid, if any student got 48 marks, so definitely he or she will be regretting for one MCQ, that if I would have been corrected a one MCQ, then I must have secured 50 marks and have gone through that paper. So always remember, never leave anything just because of it, that this standard or the part will have a lower marks. So please remember that each and every standard is important. So this will carry around 2 to 4 marks, which means one or two MCQs could be tested. One thing. Second, what is my personal opinion, that this 2 to 4 marks is a very good weighted average, is a very good average. Reason being, because the standard is not that a lengthy one. If you have seen that IS 16 was a lengthy one, IS 31 was a lengthy one, but hopefully this IS 21 is not a lengthy one. It's a very short and a precise standard, so it will not take a lot of time while we will be learning, or even while you will be practicing, or while you will be revisioning. So it will not take a lot of time. So it's a very comprehensive standard. It's not a detailed one. So by after considering this one, I think that 2 to 4 marks is a very good weightage for this particular accounting standard. Now, let's move on. What is IAS 21? What is IAS 21? IAS 21, the actual name of IAS 21 is in foreign exchange rates. Changes in foreign exchange rate. Now, what is IAS 21, and why there is a need for the foreign exchange rate? Why there's a need for this particular standard? As we have seen that every standard will give you a complete guidelines related to some accounting treatment. Like IAS 16 deals with the property, plant and equipment. That what is property, plant and equipment, how it should be accounted for, what models are available after after the recognition. Subsequent measurement could be at its cost model or at its revaluation model. In revaluation model, what should be the rules? It should be depreciated at its revalued amount over its remaining life. So these are the rules that were stated in the IAS 16. Secondly, there is another standard, that is IAS 23, that is with respect to the borrowing cost, that what is interest, and how the interest should be dealt, or how the interest should be recognized. In earlier stages, what you were doing, that you were recognizing the interest as an expense, that was you were charging to the PNL. But in IAS 23, we just came to know that interest could also be capitalized, that it could be recognized in the balance sheet as well. So this is something that we have learned from IAS 23. In IS 10, we studied that how the events that arising after the reporting date could be accounted for. In IS 37, discussed about the provisions, that how it should be recorded, when it should be recorded, when it should not be recorded. So every standard will give you a complete details and the guidelines related to certain accounting treatment. Now, in this IS 21, and why there is need for the IS 21, let's try to have a look on this one. We all know that now we are saying that global, that is, the world is like a global village. The world is like a global village. Now, what do we mean by this one? That if you're residing in Africa, I'm residing in Asia, so we are having a transaction. Every country and every nation and every continent have something in surplus, and every continent and every country has something in deficit. For example, if in Asia, I talk about the Asia, so there is a surplus of food items like agriculture product, and there's a possibility that in some other continent or in a country there is a deficit of any that there is a deficit of agriculture products. So now what will happen? In order to fulfill the need, in order to fulfill the desire, what will happen? We have now international trades. In order to fulfill the desire, we have now international trades. Now what is international trade? International trade is basically the foreign trade. And in foreign trade, what we are doing, in foreign trade, what we are doing two things. Number one, the import, and number two is the export. It means that in foreign exchange, in order to fulfill the needs and the desire of the country, every country is right now performing the international trade, to which we call it as a foreign trade. And what is foreign or the international trade? And what we are doing in that particular international trade, we are importing and exporting goods. Now, what is import? Import is basically the purchase of goods, that we are purchasing the goods, and export is something that we are selling the goods. So, which means now it is basically the essential need of every country. No country can say it that we are not importing the goods, we are not exporting the goods. It's not possible. Every country, even if you talk about the America, that is United States, although having all the resources, having a very good and the powerful nuclear power, everything uh, they have, but still they are importing certain goods and they are exporting certain goods, which means that import and export is an essential thing for every country, for every nation, for every continent. Now, if we are having an import and export, which means we are dealing with other countries right now. So while we are dealing with the other countries, what will happen? For example, if I'm importing goods, importing, for example, I'm residing in Pakistan and I'm importing goods from US, that is America. So if I'm importing certain goods from America, so what I'll be doing, that I'll be what I'll be doing, that I'll be purchasing the goods, I'll be purchasing the goods, I'll be purchasing the goods, and I'll pay that amount obviously in US dollars. Is it? I'll pay that amount in US dollars, but definitely I'll be recording that amount into my books in PKR, that is Pakistani rupee. Same in the way, if I take your examples, for example, you are living in Syria and you are having a transaction with United States and you are importing the goods, and definitely you'll pay the amount in dollars, that is US dollars, but obviously you'll be recognizing an amount in, what do we say, what is the name of the Syria currency, by the way? Can anybody please let me know the name of the Syria currency? What is the name of Syria currency? Yes, anyone?
Leons, Leons.
Leos.
L-E-E. Yeah.
Okay. L, can you please spell out?
LE.
N-L-E. N-L-E. N-L-E.
LLE.
N
Okay,
N-L-E.
NL.
Nets.
Okay, okay. NLE. Okay. So definitely you'll be recognizing in your local currency. So what's happening over here, that we're paying the amount in United States dollar. It's not necessary that we're paying the amount in dollars. For example, if I'm having a transaction, for example, if the Pakistan is having a transaction with let's say UK, so definitely what we'll be doing, that we will be recording the transaction in PKR, but definitely we'll be paying the amount in pounds. We'll be paying the amount in pounds. So, which means that whenever we have a transaction with some other country, there is a conflict. And what is that conflict? We are paying the amount in the international currency, but definitely we'll be recording in the local currency. Like as you have done, that you paid me the amount in terms of dollars, but definitely if you're recording an expense in your books, so definitely you must have recorded that amount in terms of your local currency. Is it? So which means that once we are doing the import and the export, or we are dealing with some other countries, so there is a usual problem. There's not a usual problem, but there's something that we encounter, that we pay in different currency but we record in different currency. Now what is the problem actually? Why this standard is being introduced? Let me give you an idea for this one. For example, today I purchased a goods with $3,000. Today I purchased a goods with the $3,000. Okay, but I promised to pay after 3 months. Okay, and that was purchased on 1st of October 2018, and I promised to pay this amount in the month of January. In the month of January, I will pay this amount in the month of January. Now, that is, I purchased this on credit. Now, on the date when I purchased the goods, the exchange rate in Pakistan, there's always an exchange rate. Okay? So exchange rate in Pakistan was, let's say, 100 rupees per dollar. That is, dollar one is equal to 100 Pakistani rupee. $1 is equal to 100 Pakistani rupee, which means if I just convert this amount, that it means in Pakistani rupee, in my local rupee, it will become 3000 multiplied by 100. Is it? So this will make 300,000 Pakistani rupee. I repeat my words. I repeat my words. For example, that I purchase goods in terms of dollars, that is $3,000, but obviously I'll be recording that amount into my local currency. So what I did, I just converted that amount into 100. That is, I just multiplied it with 100. Why? Because that is something, the exchange rate. Exchange rate is something, the rate at which the international currency can be exchanged. So which means if I want to buy 1 US dollar, so what I have to do, I have to pay 100 local currency. I have to pay 100 Pakistani rupees so that I could buy 1 US dollar. So I just converted that amount into the local currency, and the amount is 300,000. Now let's please be focused on this one. Let's say my year end is on 31st of December 2008. Remember, I haven't paid this amount yet. I will pay this amount in the month of January. So when I was in 31st of December, I was assessing that what is my liability. So my liability was 300,000 accounts payable. But since I just looked at the exchange rate on 31st of December, so it was around 1 US dollar is equal to 1 US dollar is equal to 110 Pakistani rupee. 110 Pakistani rupee. 110 Pakistani rupee, which means exchange rate is changed. And always remember, you must have idea about this one, that exchange rate between the currencies will never remains the same. It will always fluctuate. It will always vary. So on 31st of December, what I saw that $1, 1 US dollar is equivalent to Pakistani 110 rupees. Wait. What happened? When I had a transaction, it was around 100 rupees per US dollar. But today on 31st of December, it's 110 rupees per US dollar, which means if I will pay today, I will not pay I will not pay 300,000, but I will have to pay, that is 3,000 multiplied by 110. 3,000 multiplied by 110. Can anybody please calculate this one? 3,000 multiplied by 110. So this will make around 330,000, which means because of the change in the exchange rate, because of the change in the exchange rate, now my liability is not 300,000, although the liability is increased to 330,000. Still haven't paid that amount. I'll be paying that amount in the month of January. That is the month of payment. So what happened over here, that on the date of reporting, what I saw that the reporting date, the exchange rate was changed, and because of this change, now my liability is not 300,000, my liability is 330,000. 330,000. Now there is a change in the liability. At the time of the transaction, it was 300,000. At the date of reporting, it's 330,000. So what do you think, guys? Should I record the liability at 300,000? Yes, please, everyone participate. Should I record the liability at 300,000? Yes, please participate.
I think the
I
liability should
think,
be
hello?
330,000.
I think the liabilities will be 30,000 instead.
Okay, great. Yes, its
Uh,
liability
uh,
should not
Yeah,
be. Yeah,
yeah. Hello.
yes.
If I may contribute, being that when we are recording, we use the historical cost concepts, so we can record the liability using 300,000 instead of 330,000.
If you just forget about the historical cost, and if I just talk you about the rational, Fatima, what do you say that at 31st of December, what would you say that what is your obligation right now, either to pay 300,000 or you're going to pay 330,000?
330,000.
Nice, very good. That is the situation. Now we are going to recognize the liability at 330,000. So now what's the problem here? That at the time of the transaction, our liability was 300,000, but at the time of reporting, while preparing the balance sheet, the liability is around 330,000. Now there is a question. Now there is a question how to deal with this situation. How to deal with this situation? Whether we should increase the liability or not, or if we increase the liability, what should be the treatment, how it should be accounted for, how it should be adjusted. Yes, for this we have IAS 21. We have IAS 21. Let's move on towards the title. What is the title of IAS 21? It deals with the changes in the foreign exchange rate. Now, it deals with the foreign exchange changes in the foreign exchange rate. Always remember, at the time of transaction, the exchange rate was 100. At the time of reporting, the exchange rate is 110. And let me give you another insight for this one. Let's move on. While you were going to pay the amount, when you were going to paying the amount, that is in the month of January, you just found out, my goodness, I just found out now the exchange rate is around 120. Now please keep your hand on your heart. Please keep your hand on your heart, and and please give me the solution and give me the answer for this one. Give me the answer of the statement for this one, whether I'm going to pay that 330,000 now, whether I'll be paying 330,000 now. Everyone, please let me know.
No, you will pay 360,000.
Yes, I'll be paying 360,000. How did you calculate this one? That is $3,000 multiplied by 120. This will make 360,000. Guys, are you getting a point?
Quite clear.
Yes, sir.
So which means there is a huge problem. And what is that problem? That because of the change in the exchange rate, just look just look at this one. At the date of transaction, the exchange rate was $1 is equal to 100 rupees. At the time of reporting date, the $1 was equal to 110 PKR. And at the time of the payment, now the dollar rate is 120 local currency, which means there is a change in the exchange rate. Now, how to deal with these changes? That is something that IS 21 will explain you. That is the name of this standard, changes in the foreign exchange rate. That how to deal with the changes in the foreign exchange rate. That whenever within the organization, if you see that there's a change in the exchange rate, and this will happen, always remember, this the basic purpose to introduce this standard was that the exchange rate will never remain same. If you just want to demonstrate it, you can demonstrate in your own country that your local currency along with the dollar, along with the pound, along with the for any other country currency, it will never remain same. It will always fluctuate. At times it will increase, at time it will decrease. So which means this is known as what the change in the foreign exchange rate. So what we are going to see, what we are going to look into this standard, we are going to check it out, that how to deal with these changes, how to deal with the changes, how to deal with changes. That if the exchange rate changes, how to deal with this one. Are you guys getting the scope of this standard? Yes, everyone, please. I haven't started this standard right
Yes,
now, but I just try to give you the scope, the vision, and the understanding of the standard, that why this standard we are learning. I always try to give you the learning and understanding of the standard first. That in IS 23, I told you that why we are going to study this standard. IS 37, first I gave you an introduction that why we are going and what we are going to study in this standard. And like in that particular standard, IS 21, what is the objective of this standard? That the if we are doing the international transaction, like we are doing import or export, so there will always be a change in the exchange rate. So how to deal with that particular change, this standard will let you know. Are you guys clear with this one? Please let me know.
It's
yeah.
quite clear.
So,
Yes, sir.
yeah, it's quite clear.
Okay, great. Let's move on. Now IAS 21 explains this one in this standard, that currency can be divided into three categories. There are basically three types of currencies. There are basically three types of currencies. Now, what are those? Number one, number one is the presentation currency. Number two is the functional currency. And the third one is the foreign currency. Now, let me explain you with this one. That IS 21 states that there are three types of currencies. Number one, the presentation currency. Number two, the functional currency. And the third one is the foreign currency. Now, what is the difference between these three? Presentation currency. The currency in which the financial statements are prepared. Number two, what is functional currency? I will explain you this one. What is functional currency? Currency in which business operates or incur operating or financial expenses. Foreign currency, the definition given by the standard is other than functional currency. Now, let me give you an explanation for this one. What is presentation currency? The currency in which the financial statements are prepared. For example, that I live in UK. So what I'll be doing, I'll be preparing the financial statement. I'll be preparing the financial statement in pounds. So this is known as what, the presentation currency. For example, if I'm living in America, so what I'll be doing, I'll be preparing the financial statement in US dollars. For example, I'll be living in Sierra. So whatever the local currency is, that I'll be preparing the financial statement in that particular currency. So the currency in which the financial statements are prepared is known as what, the presentation currency. Now, what is functional currency? Functional currency, the other name of the functional currency is basically the local currency, the currency in which you are doing the transactions. For example, you are paying salaries to the employees in terms of dollars. You're paying rent in term, you're paying rent to your landlord in dollars. You are purchasing goods from the supplier in dollars. You're selling goods to your customers in dollars. You're borrowing loan amount from the banks in dollars. It means what you are doing, that you are performing all of your operating and financing activities. You are performing all of your operating and the financing activities in dollars. So the dollar is your functional currency, the currency in which you are incurring the transactions, the currency in which the business operates, the currency in which the business incurs the operating or financial expenses. It means if you are taking loan, if you are purchasing goods, if you're selling goods, and if you're paying to your employees, if you're paying rent to your landlord, if you're paying advertisement cost, if you're paying utility bills in pounds, in pounds. So it means that you are incurring the amount in terms of pounds. So this will be known as what, the functional currency. So pound will be your functional currency. So the currency in which you are operating. So the currency in which you are operating. So the currency in which you are doing the operational expenditures is known as what, the functional currency, or we can call it as a local currency. Now, to be very honest, what I have seen that the functional currency and the presentation currency are almost same. Yes, obviously. For example, if I'm doing the transactions in dollars, so definitely what I'll be doing, I'll be recording my, or I'll be preparing my financial statement in terms of dollars. For example, if I am doing all the transactions in pounds, I'm paying salaries to my staff in pounds. I'm paying rent in pounds. I'm paying, for example, interest in pounds. I'm taking loan in pounds. I am purchasing goods in pounds. I'm selling goods to my customer in pounds. So it means pound is my functional currency. And obviously, I'll be preparing the financial statement in pounds. So presentation currency and functional currency is are the same. Ideally speaking, in 99% cases, both currencies will remain same. If your functional currency is dollar, so it's 99% quite obvious your presentation currency will be dollars. If your functional currency is pound, so 99% cases your presentation currency will be pounds. Are you getting a point? Are you guys getting this one?
Yes, quite clear.
Now, let's move on towards the foreign currency. What is a foreign currency? Foreign currency is basically an other than the functional currency, and that is a very good definition that a standard has given. What does it means? That other than your local currency, functional currency means that is the local currency. All currencies are foreign currency. For example, if I would say that Pakistani rupee is my functional currency, is my local currency. So it means other than the Pakistani rupee, all currencies, every currencies around the world, for example, dollar, pounds, taka, Syria currency, Gambia currency, or any country, if I talk about, so it means UAE dirham or real, any currency I've talked about, that is the foreign currency for me. It means other than my local currency, other than the currency which I am using, other than the currency which I am using, all currencies are known as what, the foreign currencies. That is a very good definition that is given by the examiner, that is given by the standard. That foreign currency is the currency that is other than the functional currency. Whatever the currency you have, other than this one, all currencies are known as what, the foreign currencies. Are you guys clear with this one?
Yes, sir.
Everyone, please let me know.
Quite clear.
Yes,
Yes, it's
anyone wants to
clear.
ask? Okay, great. Fatima, are you clear with this one? Andrew?
Yes, sir. Yes, sir.
Yes, sir, it's clear, sir.
Okay, great. Now let's move on. So what I did that I just gave you an introduction for the currencies. There are three type of currencies that will be dealing with here. Okay. Now what is the problem? The problem is that we have a transaction in a foreign currency. We always have a transaction in a foreign currency. We always have a transaction in a foreign currency, which means we will be paying or even receiving the amount in foreign currency. And the problem is that we'll be recording the transaction, we'll be recording the transaction, we'll be recording the transaction in functional currency. That is the problem. That we incur a transaction in foreign currency, we pay the amount in the foreign currency, we are paying in dollar, but obviously in our books we'll be recording the amount in the presentation or the functional currency, because we all know that the presentation and the functional currency is quite same. So we'll be recording the transaction in functional currency, but obviously we'll be paying the amount in the foreign currency. Are you guys getting this one? Are you getting this problem? That is a problem basically. That is the problem. We can't say the problem, but that is something that we have to consider it. It is something very natural that we are dealing with any other country. For example, if you're dealing with the China, so what you'll be doing? Will be paying your local currency, that is the Sierra currency? No. Will you guys be paying your Gambia currency? No. What you will be doing? You will be paying some international currency. But if you're recording the transaction in your books, so definitely you'll be recording at your local transaction, that in your local currency, that is in your functional currency. So that is something the problem, or you can say that that is something we need to consider it. So now how to do this one, how to tackle this situation? For this, one more thing that IAS gives you an explanation. Another thing that IAS gives an explanation, that is about the date. There are three types of dates that we need to consider. Number one is basically the transaction date. Second is the reporting date. And the third one is the settlement date. Now let's understand what are these three dates. Transaction date is the date at which the transaction arises, or we can say that the risk and rewards are transferred. The date at which the transaction arises or the risk and rewards are transferred. Reporting date, we all know that the date at which financial statements are prepared. The date at which the financial statements are prepared. Now, what is the settlement date? Settlement date is basically the date at which the payment will be made. Now, these are the three important dates, and seriously speaking, what we will be doing the accounting treatment on these three different dates. That is the crux. That is a simple treatment what we'll be doing. First date, transaction date, the date at which the transaction arises, the date at which we are transferring the risk and rewards of the goods. For example, I purchase a good on 5th of January 2019. So if I purchase the goods on 5th of January 2019, so what is that? It is the transaction date. I repeat my words, okay? 5th of January, what I did, let me give you an example for this one. On 5th of January, I purchased the good, and on 30th of June, we are going to prepare the financial statement, and on 1st of September I'm going to pay the amount. Now, will you guys please let me know that 5th of January, I repeat the example. Please concentrate, everyone. I'll be asking a question from you guys. On 5th of January, I purchased the goods. On 30th of June, that is the accounting year end. That is the accounting year end. And on 1st of September, I will pay the balance amount to the supplier. Now, can you guys please let me know that on 5th of January, that 5th of January is what date? Which date it is known as?
Transaction date.
Transaction.
Yeah, it's a
Transaction
transaction
date.
day. Nice, very good. Now, can you please guide let me know that what is 30th of June?
Reporting date.
Your reporting
Reporting
date.
date.
Yeah,
Reporting.
nice, very good. It's a reporting date. And can you please guys let me know that on 1st of September, if you're paying to the supplier, so what is that particular date?
It's called settlement date.
Settlement date.
Settlement
Yes,
date.
if you're paying the amount to the supplier, so that is known as what is settlement date. Now, what are the rules? Always remember there are rules for the date. There are rules. And what are those rules? Number one, let's have a rule for the transaction date. If you're doing the transaction on some date, what you have to do, let me give an example for this one. For example, I purchased goods for $1,000. I purchased goods for $1,000, and the exchange rate on that particular date is $1 is equivalent to $1 is equivalent to rupee, let's say, uh, 50. $1 is equivalent to rupee 50. Now, if I want to recognize this amount, what do you think that should I record this amount in dollars?
Not really.
Should
No,
be
we are,
recorded in.
Record it in your own currency.
yes, I'm going to recognize this amount in my own currency. I'm going to
Yes.
recognize this amount in my own currency. So what I'll be doing in order to calculate my own currency, what will be the procedure? Can you guys please let me know?
You have to convert it to the
Okay, okay,
rupees.
okay, okay. Mamaduba, very good, very good. What term you have utilized? What term you have used? You have to what?
Convert.
Okay, wait. Please, can you please repeat that word for me?
Convert it into rupees currency.
Convert. What you have to do? You use the word that we have to convert. Okay. IS 21 states that please do not use the word convert. It's not convert. It's translate. So we are going to use the word translate. Okay. From now onwards, you were very perfectly fine. That what you say that we have to convert that amount. Yes. Previously, when I never studied about IS 21, I used to say this one that we have to convert the amount. You just find out many laypersons in your surrounding, they will be using that term that what we are doing, we are converting that amount into a local currency. But please stop them. Do not use the word convert. Use the word translate. Are you guys getting our? Are you guys getting me? Please let me know.
Yes, sir.
Yes, sir.
Thank you.
So what
Quite
we are
clear.
doing, we're not going to convert it, we are going to translate. So what we are going to translate, we are going to translate from foreign currency to functional currency. Are you guys getting my point? So what we are going to do, that we are going to translate. Please do not use the word convert. I'm not saying that convert is an incorrect word, but as for IS 21, it's never being used. IS 21 at every places uses the word translate. So what we are going to do, we are going to translate the foreign currency into the functional currency, and we are going to translate it at spot rate. Now, what is the spot rate? What is the spot rate? Spot rate means the exchange rate, the exchange rate on the date of transaction. On the date of transaction, We are going to translate the foreign currency into functional currency at a spot rate. And what is spot rate? It's exchange rate on the date of transaction. On the date of transaction. That is known as what? The exchange rate or the spot rate. Like here, the spot rate was $1 is equivalent to 50 rupees. So that was the exchange rate. That was the exchange rate. So what we did, we translated that amount. We translated that amount according to the spot rate. That was basically the spot rate. That was basically the spot rate. So what we did, we just translated the foreign currency into the local or the functional currency at a spot rate. And one more thing, I'm going to write it down over here, and you will definitely get the explanation or understanding once we will attempt one question. There will be no exchange gain or loss. Now, what do we mean by this one? I'm not going to tell you or explain you right now. You will explain, you will learn it once we will attempt the first question. So I'm just keeping it right now. I'm not discussing it, and we'll discuss it once we will attempt the first question. Now, reporting date. What are the rules related to the reporting date? That once you move towards the reporting date, for example, now the exchange rate is $1 is equivalent to rupees, let's say 60 now. And this could happen that after, for example, on 1st of October, if we had a transaction date, sorry, on the 1st January, we have a transaction date. So on 30th June, after 5 months or 6 months, obviously the exchange rate would change. Now the exchange rate is $1 is equivalent to 60 rupees. Now, if the exchange rate is $1 is equivalent to 60 rupees, so what we are going to do, we are again going to, can you please let me know what we are going to do?
We translate.
Sorry, can you please repeat?
Translate.
We translate. We translate.
Okay, we translate, or we can say that we are going to retranslate. I'm using the
We
correct
translate.
terminology. We are
Yes.
going to what? Yes, we are going to
Retranslate.
retranslate. Yes, we are going to again translate. So again translate means we are going to retranslate it. We are going to retranslate, and we are going to retranslate what? Again, the foreign currency into. Please complete my sentence. We are going to retranslate the foreign currency into where?
Local currency.
Local
Local currency.
currency, or we can say
The
that the
functional,
functional currency.
functional
Yeah,
currency.
yes. Try to use the technical terms that are being used by the, no doubt, local currency is absolutely right. Conceptually, local currency is absolutely right. But please try to use the terminology which are being used by the IS 21, so that if you have a conversation with some experts in your organization, so if you be using these kinds of terminology, this will give a very good impression on the other one, that he knows some conceptual words. Otherwise, everybody in your surrounding will be using the local currency, convert the amount, local currency. But since if you have learned something, if you just gonna to apply it, oh come on, man, translate the foreign currency into functional currency. Oh my God, this will create a very good impression to the other party. Okay, now. So we are going to retranslate that foreign currency into functional currency, but this time we are going to retranslate it at closing rate. Now, what is the closing rate? It's nothing, my dear. It's nothing. Closing rate is basically the exchange rate at reporting date, which means that on 30th June or 31st of December, when we are preparing the financial statement, we're just going to look at the exchange rate. Oh, okay, exchange rate is, let's say, for example, 60. So this is known as what? The closing rate. Why we are calling it a closing rate? Because the exchange rate at the date of reporting date, or the exchange rate at the date of year end, is known as what? The closing rate. Are we guys clear on this one?
Clear,
Yes, sir.
clear.
Yes. Yeah.
Now, another rule for this one, and I'm not going to explain you right now this rule. I'll be explaining you when we will start with the question. And what is that rule? That there will be a exchange gain. Remember, in transaction date, what I said, there will be no exchange. But in reporting date, I'm saying that there will be exchange gain, or even there could be an exchange loss and such exchange gain or loss will be transferred to P&L. Now there's something behind it. Huh? I'm going to explain it, but later on. Once I will do the question, I will explain you. So far, I'm just giving you the rules. I'm just giving you the rules. So once we'll start the question, we are going to apply all of these rules. Now, coming back to the last date, that is the settlement date. For example, while we are going to settle the amount, oh my goodness, we found that now the exchange rate is again fluctuated, is again changed, and this time now it's 70 rupees per US dollar. Now, can you please use the terminology that while we are making the payment, what we have to do again?
Retranslate.
Nice, very good. What we have to do that we need to,
Retranslate.
yes, we are going to retranslate it again. Can you please complete the sentence? Come on, guys, please participate. Have some energy.
Retranslate
Into functional
with
currency.
functional currency.
Yes, from foreign currency to functional currency. Very good. Functional currency. And at what rate it should be? That is the spot rate. And that is known as what? The
Appropriate.
spot rate. And what is the spot rate? That is the exchange rate at the time of settlement. This is what basically the spot rate. But the question is, sir, that how we are going to know that what is the exchange rate? What are the exchange rate? What are the exchange rate at the date of reporting, at the date of settlement, at the date of transaction? So please don't worry about this one. Examiner will tell you. Examiner will give you the details regarding the exchange rate. That what are the exchange rates at the date of transaction? What are the exchange rate at the date of reporting? What are the exchange rate at the date of settlement? So are you guys getting this point?
Yes, sir. Yes, sir.
Now, one more thing, last rule, but still, again, I'm not going to explain it to you right now. What is that rule? That there will be again a exchange gain or there is going to be the exchange loss. But remember, again, this exchange gain or loss will be transferred to P&L. I'm not explaining you right now, but once I will start the question, I will going to explain you that what do we mean by this one. Are you guys clear with this one? Two things so far I have discussed. Number one, that the types of currencies. Number two, there are three types of dates. Two things that I have discussed that is very important. Number one, the discussion regarding the currency, and the second one, the discussion regarding the dates. So are we guys clear on this one? If you are clear on this one, then we can move it on. Move on.
Yes, sir.
Yeah, I think it's clear.
Okay, great.
Yes,
So
it's
now
clear.
nice, very good, very good. By the way, Mohammed Uba,
Yes, sir. It's clear.
okay, great. Mohammed Uba, Mariama hasn't joined this session. I just forgot to.
Yes, he
Did you?
communicate that she not be having, yes, her phone is having a, she was stamping for a customer, then she stamped on the screen, so she,
Okay, great, great. Okay,
yes, yeah.
okay, great. Let's move on towards the another and the third and the last part. Then we are going to practice it. Okay. Then we will be done with the theory area, and then we are going to practice it. Now, IAS 21 also states that there are two types of items. Number one, the monetary items, and the second one is the non-monetary items. Now, what do we mean by this one? Monetary items. What is monetary items? Monetary items are receivables and payables, which means all kinds of receivables and payables are known as what monetary items. For example, if I just talk about the examples of monetary items, for instance, accounts receivable, it's a monetary item. Accounts receivable is a monetary item, or accounts payable, it's a monetary item. Notes receivable or notes payable, it is also a monetary item. Likewise, loan receivable, or we can say that the loan payable, it's also a monetary item. So all kinds of receivables and payables are known as what the monetary items. Now, what is non-monetary items? Non-monetary items. What are non-monetary items? So it's a very simple definition. Other than receivables and payables. What do we mean by this one? That other than the receivable and payable, if you just set aside all the receivable and payable, anything in the surrounding will be considered as a non-monetary item. That there is a very huge list. For example, the property, plant, and equipment, it's a non-monetary item. Machine is a non-monetary item. Equipment is a non-monetary item. Merchandise is a non-monetary item. Merchandise is a non-monetary item. For example, software, it's a non-monetary item. For example, let me give you another example. License, yes, it's a non-monetary item. For example, patents, copyright, it is a non-monetary item. Copyright, it is also a non-monetary item. So are you guys getting it? So these are known as what, the non-monetary items, which means other than the receivables and payables, every item will be considered as a non-monetary item. So what are monetary items? Monetary items means receivables and payables. Are you guys getting my point? Yes, everyone. Fatima, Sophia, Andrew, Anil,
Yeah,
Mohammad.
it's clear for my side.
Yes, we are
Clear,
getting the
clear.
point.
Yes, sir, it's clear.
Okay, great. Now, so what IAS 21 states that if you're having a monetary items, what we have to do, we need to what we have to do that we need to retranslate it. We need to retranslate it. And when we have to retranslate it, at the date of reporting and at the date of settlement. I don't know, but I think that you guys should be able to link it, that we must have gone through this terminology, that we need to retranslate it when at the time of reporting and at the time of settlement. Wait. Let me check it out. Let me check it out. That we are going to retranslate it. Yes, when at the time of reporting, and we are going to retranslate it. We are going to retranslate it when at the time of settlement date, which means the monetary items will be retranslated at the time of reporting and at the time of settlement, while non-monetary item like property, plant and equipment, machine, equipment, merchandise, furniture, license, buildings, and everything, these are the non-monetary items, should not be retranslated, should not be retranslated. Remember, non-monetary items means like furniture, machine, merchandise, building, equipment, or software, license, copyright, patents. These are the non-monetary items. It should not be retranslated. You're not supposed to retranslate it. Please do not retranslate it. So what we have to do? Recognize it at historic rate. Recognize it at historic rate. And now what is historic rate? What is historic rate? Historic rate is the exchange rate, is the exchange rate at the date of transaction. At the date of transaction. I'm going to explain you in detail when we are going to solve the first question. Non-monetary item, non-monetary item should not be retranslated and it should be recognized at its historic rate. And what is historic rate? It is the exchange rate at the date of transaction. When we had a transaction, when we purchase the goods, These furniture, equipment, machines, property, plant and equipment, merchandise, software should be recorded at that exchange rate, the exchange rate which was at the time of purchase, the exchange rate that was at the time of transaction. That is known as what the historic rate. Now, having said this, and we had just gone through three rules, please do recall these three rules so we can start with the question. If you are good with these particular rules, then it would be very easy for you guys to understand the question. First, we discuss the currency. What we have to do that we are paying the amount in the foreign currency, but we are recording the transaction in the functional currency. Second, there are three types of dates: transaction, reporting, and the settlement date. And on each every date, what we are going to do, we are going to translate the amount. We are going to translate the amount. And finally, we saw that there are two types of items, that is the monetary and the non-monetary items. So let's try to solve the question now. Let's try to solve the question now. We have a question over here and let's try to solve it. Okay, let's try to solve this one. Question number one. Okay, now everybody please focus on this one. Okay, a Pakistani company with rupee. Okay, first thing. Okay, one more thing I just need to give you understanding. Okay. While we are starting with the question, while we are starting with the question, step number one, that what we have to do, step number one, what we have to do, steps to solve the question, steps to, although we can start it, but to make it easier, to make it very convenient for you, I have made certain steps to solve the question. Now, how we can solve the question, let's try to understand. Step number one, step number one, first identify your functional currency. Identify your functional currency. First of all, while reading the question, you need to identify your functional currency. That which one is your functional currency or the local currency, because you will be doing an accounting for some company. You will be doing the accounting for some company, so you need to identify that for which company you are doing the accounting. That is, you need to identify the functional currency. Secondly, second step, that identify whether your functional currency is strong or weak. You need to identify that whether your functional currency is strong. Please watch me very carefully. You need to identify that whether your functional currency is strong or weak. You need to identify whether your functional currency is strong or weak. How I'm going to identify whether my functional currency is strong or weak? For this, I'll be having some activity. Please listen to me very carefully and watch me carefully. Please do watch me very carefully. Okay. Now, for example, if there's an exchange rate is $1 is equivalent to let's say 2.5 pounds. $1 is equivalent to 2.5 pounds. Now, I just want to identify my functional currency, and this will be always given in the question. For example, examiner says that dollar is your functional currency. Dollar is your functional currency. Dollar is your functional currency. Now, this is something the information is already given. Now, $1 is equivalent to 2.5 pounds. $1 is equivalent to 2.5 pounds. Now, I need to identify whether my dollar is strong or weak. How I'm going to identify? Please listen to me very carefully. Everybody, please. Dollar is saying, let's have a fight. Let's have a fight. Come on, let's go into the ring. Okay, come on, let's have a fight. Dollar is saying that I will come alone. I will come alone. That is, I will come alone. One person. I will fight alone, man. Pounds is saying, no, 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 no. I couldn't fight. I couldn't fight with you with one person. I couldn't fight with you one person. How many person the pounds will have to bring? How many person the pound will have to bring? Please let me know. Andrew, please let me know. How many person the pounds will have to bring to fight with dollar? How many per dollar is saying that I will come alone? I will come single. How
2.5.
many percent? Yes. Pound is saying that I will bring one man. No. I will bring two man. No. I will also bring. Okay, this is something I've tried to make 2.5. Okay, Andrew,
And a
can you
boy.
make it? Yes. Can you please make this one 2.5? Can you this one? This is three. This is 2.5. 3, 2.5. 3, 2.5. Can you make? Can you this one, Andrew?
That's two giants and a dwarf.
Yes, I'm going to bring two men and a kid. And a kid. Is this? So, in order to fight with the dollar, the pound will have to bring 2.5%, like this one, right? So, what do you think? What do you think that who is stronger? Dollar is stronger or pound is stronger?
Dollar is
You guys,
stronger.
yes, everyone, you guys, please decide this one. Mamaduba, Sophia, Fatima, Andrew, you guys decide depending on this fight. On the basis of this fight, on the basis of this fight, you guys will decide that which one is stronger. Yes,
USD.
USD is stronger. Yes, why? Because USD is saying that I will bring one man. Pound is saying no, 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 no. Please don't bring one man. Please bring. I will bring 2.5. I will bring 2.5, which means pound is weaker while the dollar is stronger, which means my functional currency is strong. Are you guys getting a point?
Yes, quite clear.
Okay, great. One more. Let's have one more. Can you please, Gambia, Mohammadaba, you're from Gambia, right? So please, can you please let me know the Gambia exchange rate with the Sira? Anyone have idea about this one? That one Gambia, let me search it out. Okay.
For us here, for us in Sierra Leone, $1 is equals to 22 leons.
Wait.
Um,
69 per dollar. 69 dollars cheaper.
I think for us in Sierra Leone, the $1 is 23.7.
For
$1 is 23.7.
$1 is equal to,
23.7
and that is what 23.7 is which currency?
Sierra
billions.
Leone.
Sierra
Okay,
Leone.
okay, your Sira currency.
Sierra Leone, yes. SLNLE.
Okay, great. So let's have a fight. Let's have a fight. Okay, let's have a fight. For example, your local currency is this one. This is your local currency. Oh, so sorry, sorry. I shouldn't use the word local currency. The term which I should use, that which what should I use the term?
Functional currency.
Yes, yes, it's a functional currency. So your functional currency is Syria, and now let's have a fight. Let's have a fight. Dollar is saying that again I will come alone. Is it? Dollar is saying that I will come alone. Come on, let's have a fight. What you guys are saying? No, 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 no. We can't fight right now. We can't fight right now with one person. We have to bring how many people? We have to bring how many people? 23.7 people. And these 23.7 people are equivalent to 1% of US dollar. So what do you think? That your functional currency is strong or weak? Yes, please do let me know.
Weak,
Very
weak,
weak.
weak.
Yes, it's
Very,
weak.
very weak.
It's not very, very big. Let me tell you the exchange rate of Pakistani rupee. You will be surprised. Now let's have a fight with the Pakistani rupee. Come on. US dollar says that I will come alone. Pakistani rupee PKR says that it will be we will bring around 279%. 1 US dollar is equivalent to 279. What do we mean by this one? That US dollar says that I will come alone. Come on, let's fight. What Pakistani rupee says? No, man, no, we can't fight alone. Okay, bring two people. No, three, no, five, no, 10, no, 100, no. We will bring 279 people, then we will be able to fight with you. Now, please do let me know if my functional currency is Pakistani rupee. What do you think that my functional currency is strong or weak?
It's weak.
Comparatively to other
Weak.
countries, I think it's weak.
Yes,
It's weak.
It's weak.
now Andrew will say it's very, very, very big.
Very weak.
Very,
But
very.
it's not very weak. It's weak
It's
because
weak.
for
It's
us in
weak.
Okay.
Sierra Leone, we will just dominate our currency.
Oh yeah.
Otherwise, it would have been 22,000.
Uh,
Yes.
okay. Okay, great. So this is. Did you
Not to
guys?
worry, same thing.
So did you guys got the exercise that how we need to identify the strong and weak?
Yes.
Did you
Yes.
guys got? Okay. Okay. Now, what is the reason to identify whether the currency is strong or weak? What is the purpose behind it? Always remember, please listen to me very carefully. Please listen to me very carefully. Everyone, please. Sophia, Mamaduba, Anil, Andrew, Fatoma, everyone, please listen to me very carefully. If the functional currency is strong, then the translated amount will be lower in number. Translated amount will be lower in number. But if the functional currency is weak, then the translated amount will be higher in number. Now, what do we mean by this one? For example, if in this situation, in the weaker situation, if you are purchasing goods for $500, what you will do that $500 and you are going to translate it. So in order to translate, you are going to multiply it by 23.7. So what are you going to do? That is 500 multiply by 23.7. So this will make 11850. Now just look at this one. The foreign currency was $500, and once you have translated, so translated amount is higher in number. That means that it is more than 500. When I use the word higher in number, which means it will be more than the foreign currency. So foreign currency was $500, and once you have translated, it is the value is 11,850, which means higher in number. But if your functional currency is strong, if your functional currency is strong, so what we are going to do, for example, if you have purchased the goods for $500, and if the functional currency is strong, if you are using the dollars, so what we are going to do, we are going to bring the number in lower in number. We need the translated amount lower in number. We need to translate the amount in such a way that we need to bring lower in number, and in order to bring the lower number, what we are going to do, we are not going to multiply it, although we are going to divide it. So the 500 divided by 2.5, 500 divided by 2.5, this will make 200. 200, sorry, this is not the dollar. We have purchased goods in pounds. Okay, that was something in pounds. So the translated amount will be $200. Now what's going on? That you purchase in 500 pounds, but now the translated amount will be lower than the foreign currency. Why? Because always remember that if your currency is strong, so you will be paying lesser amount. If your currency is strong, obviously you will be paying the lesser amount. But if your currency is weak, so you will be paying more amount. That is something very logical. If your Syria currency is weaker, so obviously whenever you purchase goods from other country, you pay more amount. Why? Because your currency is weak. But if your currency is strong, obviously you will be paying the lesser amount. Are you guys getting a point?
Yes.
So
Clear, clear.
if your functional currency is strong, so always remember we need the translated amount lower in number. Now you have to see that whether you can bring the lower amount by multiplying the while doing multiplication, while doing the multiplication or while doing the division? I repeat, first rule that you need to remember, if your functional currency is strong, the translated amount should be lower in number. Now you just have to have a check and balance that how you will get the lower amount, either by multiplication or by division. Here we got the lower amount by dividing. So what we have done, we divided. If we will multiply it by 2.5, this will increase the amount. This will increase the amount. So what will be the amount? 500 multiplied by 2.5. So this will make 1250, which means this will increase the amount, but we don't want to increase it because why? Because our currency is strong, so the translated amount should be lower in number. Same situation is here, that if your functional currency is weak, so your translated amount should be higher in number. In order to make it higher, either you will multiply it or you will divide it. Now let's see that how are we going to get the higher number. While multiplying, you got the answer 8850. Let's try to divide it and let's take the answer for this one. That if we divide 500 divided by 23.4, so this will make 21, which means that will be quite lower. But our functional currency is weak, so we need higher amount, and this will bring the higher amount by multiplication. So please remember this rule, that first thing that you need to identify whether your functional currency is strong or weak. If your functional currency is strong, so translated amount should be lower in number. If your functional currency is weak, so translated amount should be higher in number. Then we will see that whether we get the lower amount by multiplying or by dividing. So on the basis of this one, we will decide whether to multiply or divide. Are you guys clear with this one now?
Quite clear.
Now, we have done a lot of theories, but unless we will not practice, this will not be clear to you guys. Now, let's try to solve this first question now. A Pakistani company with rupees at its functional currency. First thing that you need to identify that rupee is the functional currency. Rupee is the functional currency. Rupee is the functional currency. Okay. Has a financial year ending on 31st of December. We are having an accounting period ending on 31st of December. It buy goods from the Australian supplier with Australian dollar as its functional currency on 1st of December 2006, which means Pakistani currency. Yes, Anil, would you like to ask something?
Could you please zoom it a little bit bigger?
Okay, okay, need to do bigger. Okay, Anil, now is it visible to you guys?
Yes.
Okay, a
Thank you.
Pakistani company with the rupee at its functional currency, which means we are doing an accounting for the Pakistani currency, and rupee is our functional currency. And financial year end is ending on 31st of December. Now, Pakistani company buy goods from an Australian supplier. We have bought the goods from the Australian supplier, and the Australian dollar is the functional currency for them. It's not for us. Our functional currency is Pakistani rupee. On 1st of December 2006, invoiced in 10,000 Australian dollar, which means we bought goods on 1st of December 2006 for 10,000 Australian dollars. Can you please guys let me know that this 1st December 2006, which date it is? Yes, anyone, please.
Is the transaction date?
Very good. Excellent. This is basically the transaction date. Now, let's move on. The Australian supplier is eventually paid in March 2007. Can anybody please let me know which date it is?
The settlement date.
Nice. Very good. It is basically the settlement date. So, anyone, please can let me know that where is the reporting date? Hello. Hello, can you please guys let me know the reporting date? Hello, anyone?
Yes, sir.
Where's the reporting date? Or which one is the reporting date? The reporting date is the one that is the accounting year end or the date at which the financial statements are prepared. Can you guys please identify that where is the reporting date?
31st December 2020.
Yes.
Yes, that is 31st December is basically the reporting date. Yes, this is the reporting date, right? Now, let's move on. Exchange rates over the period were as follows. On 1st December, we were having an exchange rate of 1 Australian dollar is equivalent to 75 rupees. On 31st December, 1 Australian dollar is equal to 80 rupees. And on 31st December, 1 Australian dollar is equal to 81 rupees. What we have to do, we have to do the accounting on transaction reporting and the settlement date. Now, listen to me very carefully. Step number one, first we need to identify that which one is the functional currency. Yes, please let me know. Our functional currency is what? Which one is the functional currency? Yes,
The rubies, the rubies,
yes, it's rupees. It's Pakistani rupee, right?
rubies,
Now,
yeah.
step number two, we need to identify whether the Pakistani rupee is strong or weak. How are we going to identify? For this, we need to have a fight. Okay. For this, we need to have a fight. And how we are going to fight? Let's take this one. That what it says that 1 US dollar is equivalent to Pakistani 75 rupees. Okay. Let's have a fight. Let's have a fight. Australian dollar is saying, US dollar is saying, USD is saying that we will come alone. Come on, Pakistanis, we will come alone. What Pakistan says, what Pakistani says, we are not going to come alone. We cannot fight with you alone. We have to bring 10, no, 15, no, 20, no, 25, no, 50, no. We will bring 75 people and then we will be able to fight. So please do let me know whether my functional currency, this is my functional currency, whether my functional currency is strong or weak. Yes, please let me know. Yes, anyone?
Weak, sir.
Yes, it's weak. So which means the translated amount should be higher in number or lower in number. If the functional
It
currency is
should be
weak,
higher in number.
yes, nice. It should be higher in number. It should be higher in number. And how are we going to how are we going to make it higher? By multiplying or by dividing?
Multiply, multiply.
Yes, yes, we are going to multiply it. We are going to multiply it. Now, how are we going to solve this one? Listen to me very carefully. On 1st of December, we purchased goods. We purchased goods. Now we are going to make an accounting entry for this one. How are we going to make the accounting entry? That is the purchases. Purchases will be debited and accounts payable will be credited. Remember, we purchased the goods with an Australian dollar of 10,000, which means 10,000 Australian dollar. 10,000 Australian dollar. Now, what we have to do, we need to translate it. We need to convert it. No, 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 no. We are not going to use the word convert. We are going to use the word translate it. And in order to translate it, how are we going to translate it? We need to use the exchange rate that is on that particular date is 75. So what will be the amount? Can anybody please let me know? 7,50,000?
75,000.
7,50,000, I guess.
Yes, yes.
Yes, it's 7,50,000. So what we have done, we recorded the transaction on 1st December that we purchased goods, purchases debit and accounts payable credit with the amount of 7,50,000, right? Now, what we are going to do next, second step, on 1st December, on 1st December, we had a transaction. On 1st December 2006, we had a transaction and we have recognized a liability of 7,50,000. Now, what happened? just after a month, that is on 31st of December 2006, we had a reporting date. It means at which the financial statements are closed. And what we have seen that on 31st December, the exchange rate is changed. And now the exchange rate is 80 rupees per per Australian dollar. What do you think that whether my liability will remains the same? What do you think, guys? Whether my liability will remains the same? Yes, guys. What do you say? That whether my liability will remains the same? If, for instance, the exchange rate is being changed from 75 to 80, so what do you
Increase.
think?
It will increase. It won't remain the same. There will be a difference.
It will
Increase.
change.
It will change. Yes, it will change. Now, what will be the liability? What will be the liability? For example, if I would say that now I will not have to pay 750. Why? Because on the reporting date, now the exchange rate is 80. Exchange rate is 80, right? It's rupees 80. And what we have to do, we have to multiply it by 70, sorry, $10,000, right? So 10,000 multiplied by 80. So this will make how much amount? How much amount?
800,000.
Nice. Now, what do you think, guys, that whether my liability is increased or decreased?
Increase.
It
It's
increases.
increased, right? And it increases by what
After
amount?
loss.
It increases by
Yeah.
what amount?
50,000.
Yes, it increases by rupees 50,000. It increases by rupees 50,000, right? So now at the date of reporting, 31st of December, what happens that unfortunately the exchange rate was changed and my liability was increased. So if liability is increasing, so whether the liability is increasing, so liability increases, it will be debited or credited?
Credited.
Yes, liability increases, it will be credited. And by what amount the liability will increase? It will increase by 50,000. It will increase by 50,000. And what do you think, guys? My liability was 750,000 and now my liability is 800,000. What do you think, guys? Whether it's a favorable situation for me or unfavorable situation for me?
Not
Unfavorable.
favorable.
Sorry,
It's not favorable.
it's not favorable. What do you think, guys? It's a benefit for me or it's a loss for me?
A loss.
It's a
Okay, what do
loss.
you think? What do you think, guys? It's a gain or it's a loss?
A loss.
Yes.
Yes, it's a loss. It's a loss. So what we are going to do? So we are going to debit the loss, but we are recognizing this loss with the term exchange loss. Why it's being debited? Because loss is an expense, and once the expense is increased, it will be debited. So exchange loss will be debited, and the accounts payable will be credited. Are you guys getting this point? Hello, everyone.
Yes, yes,
Yes.
clear.
So meaning here we take the differences for the next year.
Excellent. Why? Because remember, Andrew, at the date of every reporting date, we what we do, we recognize the liabilities and assets in a financial statement. So while recognizing the liability, what I did, I just retranslated what I used the term, I just retranslated, right? So what I did, I retranslated the amount. So once I retranslated, I just got to know, oh goodness, my liability is increased, and the liability is increasing, which means it's a complete loss to me. So what I did, I made an entry that exchange loss is debited and accounts payable is credited. Now this is not the end. It says that please record the entries on the transaction date. Yes, we did it. Record the entries at the reporting date. Yes, we did it. Now it says that please also record the transaction or entry on the settlement date. Now we have paid the amount on March. Now let's make an entry for March. Let's say 31st of March. We paid an amount on 31st of March 2007, that is after the reporting date. Now, while we are paying the amount, what do you think that whether the exchange rate is same? What do you think that exchange rate is same as it's same from the previous one?
It changes.
It
No, it's
changes.
changed.
It's changed. Now it's 81. My goodness, what's going on? Let's have a look. That is on 31st of March 2007. So now once we are going to pay, I'm using the word bank because I'm paying the amount. So what do you think whether I'll be paying 800,000 or 750,000? Will I be paying 800,000 or 750,000? Will I be paying 750,000 or 800,000?
800,000.
Sorry?
800,000.
No, we are not going to pay 800,000. We are going to pay 10,000 Australian dollar, Mamaduba. We are going to pay 10,000 Australian dollar. But unfortunately, on 31st of March, the exchange rate is 81. Am I right?
Yes, sir. All right.
Yes.
Which, which means 10,000 Australian dollar and exchange rate is 81. So how much amount I'm going to pay? How much amount I'm going to pay? That is 800 and
10,000.
yes.
810,000.
But you have, I don't know, but whether you have realized that the liability which I have recognized at the end of the reporting date, it was how much? The liability which I have recognized at the end of the reporting date, it was how much liability which I have recorded at the end of the reporting date?
800,000.
Yes. And now what happened? That the liability was 800,000 and you have paid the amount 810,000 and you have paid the amount 810,000, which means what do you think, guys, whether it's a favorable situation or the unfavorable situation?
Unfavorable.
Yeah,
Unfavorable.
it's a gain or loss,
A loss.
A loss.
and a loss of what amount? And a loss of what amount?
10,000.
10,000.
Yes, yes, it's a loss of 10,000. Now let's try to recognize the entry. Please give me the answer that what amount we have paid, what amount we have paid, whether we have paid 800,000, 10,000, or 810,000.
10,000.
What amount we have paid to the supplier? What amount we have paid to the supplier, Sophia?
81.
810,000.
10,000.
Yes, yes. So it means the bank will be credited with the amount of 810,000. And initially, my liability that was recorded with the 800,000, so my liability will be debited by 800,000. Why? Because I have recognized the liability with 800,000. So whatever the amount of liability I have recognized in my balance sheet at 31st of December, this will be debited. So I have debited the liability with 800,000. Oh, there's a difference in the entry. And the difference is with what amount? And the difference is what amount?
10,000.
And can you please let me know what is that 10,000? What is that 10,000?
Exchange
What?
loss.
Yes, excellent. Very good. This is something the exchange loss of 10,000. So we have recognized this exchange loss. And remember, this exchange loss that we are recognizing, this will be transferred to PNL. This is the loss basically. This is the expense. And this expense will be charged to PNL. This expense will be charged to PNL. Are you guys getting my point? This will reduce the amount of profit. Are you guys getting it?
Yes.
This will reduce the amount of profit. This is something that we are recording the expense. Now let me recall you the rules which I have told you right now, quite couple of minutes ago, that what we are doing, that once we are doing this standard, we what I said that we have three types of dates. Now you will get to know about this one. I told you that I will explain you once I will do the first question. that at the date of transaction date, we are going to translate the amount, yes, and we are going to translate it at the spot rate, and we did it. And remember, there will be no exchange gain or loss. Can you please prove this one, sir? Yes, I can prove it. I can prove it. Just see this transaction. Either whether there is any gain or loss on the first transaction date, whether there is any gain or loss.
There was none.
No, no.
There, and remember, whenever you are recording the entry on the transaction date, there will be no exchange gain or loss. This is something that I've told you, that while you are doing the recording the transaction date, so there will be no exchange gain or loss. Now let's move on towards the another date. That once you're recording the transaction on the reporting date, once you are making an adjustment in the reporting date, you have to retranslate it. Yes, we did it. And you will retranslate from foreign currency into functional currency. Yes, we did it. You have to retranslate it at the closing rate. Yes, we did it. And there will be a exchange gain or loss. And this exchange gain loss will be transferred to where? The P&L. Have you done this thing? Yes. Have you guys done this thing?
Yes.
Yes, this was basically the transaction date. This was basically the transaction date. This is something the reporting date. And what we have done at the reporting date, we retranslated the amount, and on retranslation, there will always be a gain or loss. And such gain or loss will be transferred to P&L. Now let's move on towards the last date. That is the settlement date. What we are going to do, we are again going to retranslate it, and once we are going to retranslate it, there will again be an exchange gain or loss. So do we have exchange gain or loss in on that particular entry? Yes. If you just look at the situation, that is the settlement date, and on this settlement date we have again exchange loss, and this exchange loss will be transferred to P&L. Are you guys clear with this one?
Quite clear.
Yes, it's clear.
Mamaduba, Sophia, Andrew, Fatuma.
Yes, it's clear.
Plus,
Yes, sir.
So this is something that we have done today. Today I gave you an introduction for the IS 21, and we have solved the first question. That was the basic question. And remember, please, once you will recall it, please do recall this one. This is something a very technical standard, or it's a very good standard, but you have to recall it. If you will have a good grip on that first question, remember the other questions are easy. It's not that a difficult one, but you have to understand this first question. Please do recall the lecture and try to solve this question at your own. If you have if you face any problem or the confusion, please do let me know in the next class. We are going to discuss this, and we are going to solve the other questions as well. So once we will solve the multiple questions related to that standard, hopefully the things will be in a clear shape. So are you guys clear with this one? Any question, any confusion so far?
Quite clear for my end.
Nice. Great. Thank you so much for joining. We'll continue with that particular standard in the next class. Okay.
Okay.
All right.